Today's question from the comments comes from Mike. Mike is asking, does the IRS make you offer more money if you can't pay your offer in compromise right away? What's up, guys? Corey Hankerson here from Legacy Tax, and they call me the Levy King because I've helped thousands of clients with unfiled returns, back taxes, tax liens, and that's right, IRS levies. If the IRS took your check, the Levy King will get it back. 1-877-LEVY-KING, LevyKing.com. Okay, Mike, so the short answer is sometimes yes, but it's not because the IRS is charging you a penalty or trying to punish you. It actually comes down to how the IRS calculates the value of your offer in compromise. When the IRS reviews an offer in compromise, they're trying to determine something called your reasonable collection potential, or RCP. That's basically the amount they believe they could collect from you through normal enforcement actions like wage levies, bank levies, or asset seizures. To calculate that number, the IRS looks at two main things. First is your assets, things like equity in your house, cars, bank accounts, retirement accounts, and your other property. Second is going to be your future income. They want to know how much money they believe you could pay towards the tax debt going forward after subtracting your allowable living expenses. So future income is the key because that's where the payment options actually matter. If you submit what's called a lump sum offer, the IRS is expecting to collect 12 months of your future income. And that's the formula they're going to use when they're calculating the minimum acceptable offer. But if you choose the periodic payment offer, which allows you to pay the settlement amount over a longer period of time, the IRS assumes they can collect 24 months of your future income instead. So the offer amount may be much larger, but it's not because the IRS is charging you extra per se, but rather it's because the formula they use includes more months of your projected income. Let me give you a quick example. Let's say they analyze your finances and the IRS determines that you have $200 per month of disposable income available to pay towards your tax debt. If you submit a lump sum offer, the IRS is going to multiply that $200 by 12 months, which is going to equal $2,400 in future income. But if you want to pay your offer over more time under the periodic payment option, the IRS multiplies that same $200 by 24 months instead of 12, which is going to equal $4,800 instead of $2,400. Same taxpayer, same income, same situation, but the required offer is twice as large simply because of the payment structure. That's why strategy matters when preparing an offer in compromise. The payment option you choose can significantly affect the amount the IRS expects you to offer. And choosing the wrong approach can easily cost you thousands of dollars more than was necessary. If you have any taxing questions that you need answered by a real tax pro, just drop them in the comments and I may answer it in my next video.
1-877-LEVY